W strategy is probably the easiest strategy and is one of the best strategies, especially for growing a small Forex account. Um, it's easy. It's one of the best for growing a small account. It's tailored for market manipulation, which obviously means it has a greater win rate. If you're looking for a strategy that has about a 70 and above percent win rate, then this is this is the kind of strategy for you. It's based on a theory that the markets move in cycles, and basically at the end or beginning of every cycle, we see a W or an M formation, right? That's the theory behind it, that the market moves in cycles, and at the beginning and start of the cycle, we see an M or W formation. That can be a double top, if you want to call it that, or a double top or a double bottom. But it's quite different from a double top and a double bottom, because double tops, usually the middle of the W and M touches the neckline, whereas with the M and W, it literally looks like M and W's and not necessarily a double top and a double bottom. So let's get into some charts. Let me show you the pound New Zealand. Let's go into some examples so I can show you what it means. So it's also a combination of the divergence strategy, which I have a video on where I talk about the divergence strategy and how to trade it. So if we're just looking at this pattern movement here, we're in a downtrend that we've established, but where would we be looking for opportunities? What is the W? Where are we buying? Where are we selling? So what we'd be looking for is essentially this W movement, this first leg down here that forms the first piece. Now, if you are selling here, you might get taken out, or if you're trying to buy or trade the trend strategy, you'll get taken out easily. Even if it will go in your direction and you've bought, you will still get taken out by the stop loss. But if you're trading the M and W formation, you would be buying at the second leg here. So this would be the first leg, right? And then this would be the second leg where we're looking to buy. But how do you know when to buy? You can use an indicator. You can use the stochastics, the RSI, the TDI. For, say, if you want to use the Market Maker by Steve Morrow, you can use the TDI. But importantly to note, I remember when I used to use the TDI indicator, it's not always accurate, in the sense that sometimes it's delayed, sometimes sometimes it's too early, and you'll find that you'll jump in way too early and get taken out a lot. If you don't know that, most people don't talk about that, but if you notice on the indicator, you do tend to jump in a little bit earlier. So a good one that works and which is available to most people is the stochastics. So let's jump in to see the entry opportunity. We are currently on the 1 hour and we're looking for an opportunity here. So if you haven't watched the divergence video I did, you should go check it out. Here is the clear divergence here. This was the first leg. This was the second leg. And you can see an uptrend starting to form on the indicator. Whereas on the chart pattern here, we see price go all the way to this exact same level. Not lower, but to the exact same level. But here on the indicator, we see price move above the first leg. So that would be the divergence entry on this M formation. Let's go lower. I want us to go on the lower time frames so you can possibly see if you want to enter on the 15-minute. This works best on the 1 hour time frame, I've noticed. If you try it on the 15 minutes, you are essentially looking for trouble. I'll tell you that. The divergence, when you want to enter now, on the 1 hour, on the 15-minute, it's much more clearer. So this is the pattern we're trading, right? And we're talking about entering at the second leg. Here was the clear divergence entry here. So another smaller divergence was formed on the 15-minute. Let me delete this. So another smaller divergence was created here on the 15-minute, and that's the one you can use for your entry. So you've done the analysis on the 1 hour time frame. You've clearly seen a buy divergence on the 15-minute. Here, the second leg is higher than this leg here, but on the charts, the second leg is actually way lower. So that would be your divergence entry right here. So you've done your analysis on the 1 hour, you'd be doing your entry on the 15-minute. We're done with this buy pattern here. So let's see the theory. The theory is again that basically at the end or beginning of a cycle, we see an M or W formation. So we had an entry here, and that was obviously the beginning or the end of a downtrend, right? So we started to see price push up, and then another trend started to push us further down. And we do see another W formation, just for example, so you get to see what's going on. Let's take a look at another example so you know. This is the one we entered on. Let's look at another example so you start to see this pattern clearly. I don't know where it's gone now. Let me just look for it quickly. Okay, here's the pattern, right? Let me go up. So we're looking to buy this second leg here. This would be another opportunity for you to get in. So this is the opportunity we talked about. And this would be the second opportunity. This is another similar W formation. As you can see, this leg is higher than this low leg here. So you would be looking for a buy opportunity here. And obviously you'd be looking at the stochastics indicator for a divergence buy, which we see right here. This was the entry. You could get in and move your stop loss as price moves with you. Here was a divergence again to sell at this level here. Here was the divergence. So keep moving, keep moving, keep moving. And then my favorite was last week's. Last week pound saw a huge move, and if you were on the if you did catch this move, then amazing. I got out only around here because I didn't see this W formation. I got in before the W formed. So I got in on this first leg here because I wasn't trading it as a W formation. I was just trying to enter, right, as a trend trader. So I got in on this leg, got in on this leg, and then I saw price starting to tip over, so I got out. And essentially this happened way early in the morning, so I didn't see it. So this is a perfect example of a buy opportunity on this strategy. This is the first leg. Let me just move this. This is the first leg, right? First leg, we move down to this area here. And then this is where some of us, like me, I entered here thinking it's a trend and we're beginning to go up again. Price flopped down to this area here. So what we're looking for essentially is a divergence, which tells us to buy here. If you want, you could use pin bars, but pin bars aren't very accurate. That's the problem with them. So now let's go on to the 15 minutes to get a better entry. Where's the divergence here? There was no divergence. That's the honest truth. Even on this 15 minutes, there was no clear divergence to tell you to enter. So sometimes it can be quite tricky to see the divergence. But once you see price starting to move up like this, when you see this movement here, which looks a bit like a dead cat bounce, right? A dead cat bounce is when you see a downtrend and then price slowly goes up a bit and it's about to fall again. That's when you start looking for a buy opportunity, right? And so we saw clearly price starting to reverse up. So that was the indicator, not the buy divergence, but price action, pure price action was the indicator that we're about to see a W formation. So the indicator wouldn't have helped much. What could have helped was to get into this entry. I was on the New Zealand US dollar. So you could have used the New Zealand US dollar as an opportunity to trade this one because they're correlated. So this buy opportunity here on the New Zealand US dollar, we saw the exact same pattern for a sell opportunity, and I'm gonna get to it just now. So if you understand correlations very well, you will know that if you find a pattern in a certain currency pair, you can find the exact pattern on the opposite currency or one which is nearly closely perfectly correlated. I've talked about correlations a bit. Hopefully it's clear by now what correlations are. So this would be your entry here, right? And your target would be here. If you caught this huge move here, this huge move, you wouldn't have had to trade the rest of, or even traded the entire week. One move like this on an M or W formation will set you up for the entire month. It's one trade and it will set you up for the entire month. You don't have to trade anything else for the rest of the month. You could just literally have one trade and that would be it. So this was a perfect opportunity. So now we've looked at the buy entries. Uh, we may want to look at the sell opportunities. So like I said, I did get into this New Zealand US dollar. I talked about it on my past videos. This is the one I got into. There was a sell divergence or an M. So we were looking at the W's for buys. On the sell side, we'd be looking for M formations. M formation is it starts off with a huge uptrend. Let me just remove this. Okay, so for an M formation, you'll see the start of an uptrend, right? And then a shove down here, and then a second move up, right? And I've noticed a lot of the times these second moves to form the M formation, they tend to happen at night when people are asleep. So they are great opportunities, but they tend to happen at night. And then we're going to get into how you can get into these positions at night when obviously you want to sleep. So this was the M formation here. You didn't need much of an indicator to tell you that this was going to happen because this is correlated with the US dollar. So if you were buying the US dollar, you would be looking for a sell opportunity anyways on this pair. So first leg here, second leg here. I do want to also tell you that what tends to happen a lot of the times with some currency pairs and with some brokers is that you'll find a huge spike. It's a candlestick which will spike so high that it knocks everyone's stop losses, and then it basically falls. And so this would be the take profit. Your take profit would be where the first leg started to form. So here would be your take profit. But like I've said, you'll find that even if you get the entry correct, a lot of brokers have very funny candlesticks that form along M and W patterns, and they tend to knock all your stop losses out. So you want to be very careful. Here, there's no example of that, but it tends to happen a lot. And so you want to be very careful that you're sticking to risk management and that you have a stop loss. Because if you don't, you will essentially get wiped out. You want to be very careful. Brokers also increase their spreads on patterns like this where they know everyone's trading. It's a very popular pattern. So I was looking for an M a W formation to buy, right? So this was the first leg, and I got in here for the second leg, and then I got taken out when price started to move down, and then I bought again because of a rising wedge, but that's not the focus of this video. Let's see if there are other opportunities. Right, this is a perfect example of what I was talking about. So you will find an M formation to sell, right? Here was the first leg, right? Here was the second leg. And then what I was saying was that you'll find some brokers who have funny looking candlesticks that knock out your stop losses completely. This is on the US dollar CAD, by the way. They're funny looking candlesticks that knock out your stop losses, and then price starts to go down. And if you zoom in, let's see what was happening. Right, so we're back here. I wanted to show you something interesting. So if you're not very careful, what will tend to happen is that you'll get stopped out by candlesticks like this, right? So, or this one exactly. So you will enter a good position, and then a candlestick like this, where it has a long tail like this, and they will take you out, and then automatically price will start going down, and then that's how you wake up. Your stops are taken out, and it's usually at night, around 11, 12 p.m. So you'll find that your stops are taken out, and then price moves in the direction that you had thought. And so you're like, I was correct, but how come I got taken out? It's candlesticks like this. And by the way, even though on the charts you can see price got to here, the spread is much higher. So it's way higher than you can see here, because what creates a candlestick like this is a huge movement up and then a huge movement down. So when it spikes up like that, price moves way higher than these points here, right? So that's important to note. So this is a great example of how you'll get an entry correct, but it's funny looking candlesticks like this that get you out. And it's even worse. There's some examples which show you exactly. So for example, I have marked out this W formation. Here was the first leg, right? Here was the second leg, a perfect opportunity to sell, I mean to buy. Let's see if there's a um, buy divergence there. So there's clearly a divergence here, right? So you would have gotten in on this leg here. Let's go down even further. I just want us to go to right. Excuse me. So here is the first leg forming, and then you're looking for a buy opportunity here on the second leg. Now the divergence isn't too clear here, but if you did go on the higher time frames, or say you are using the 1 hour, right? It doesn't look too clear there, but the divergence is very clear here. As you can see, this is the first leg, it's low. Here's the second leg. And so you would have gotten it perfectly timed. Problem is, some of these candlesticks will knock you out so much, you will completely be wiped out. So, yeah. So you'll get the divergence entry right, and you're correct. And then a huge candlestick, like this huge one down here, will completely knock you out. Completely. Even if you have a stop loss, which is very good, your big all stop losses were knocked out completely right here. Knocked out, and then price moved up and then created another nice divergence, and then had a funny looking candlestick, knocked a lot of people again. This was a divergence, buy divergence again, a beautiful one. And our take profit would be here. Here would be our take profit. Let's look for other formations. This was a perfect W formation. So you would buy at this leg here. This is the first leg. Price goes up, sinks to this area here. You'd be looking to buy. So here was the divergence, a perfect, beautiful divergence to buy. Here would be the take profit. You'd be out. Then here would another sell opportunity came right after this buy opportunity. We had a sell opportunity right here. So if you're wondering what's the difference between an M and W and a double top, let me just explain to you clearly what's the difference. So here we can see the W to buy, right? And our take profit is perfectly aligned with this first leg here. The difference with a W and a W and double top is that double tops look similar to this position here, where you do see M formation to sell, but price goes even lower than the target, right? So if we were, let me just delete this so I don't confuse you. So say you were trading this pattern here, right? You saw price going up, it touched this area here, came down, touched this area here. A lot of people got stopped out. Look at this, under 1 hour, a lot of people would have gotten stopped out here by the spreads. Price moves down. If it was a double top, if it was a double top, price would have moved even lower, because double tops are measured by this height here, and then you extrapolate that height to down here, to somewhere down here. So even though the movement did come, a double top or a double bottom usually continues to go down or up past the target of the first leg. So that's the huge main difference between the two patterns. I'm going to leave this open because I think I see a trade opportunity for this week on this pattern. This looks like a rising wedge for me. So price is trapped in this area here. Look at these candlesticks. So you want to be careful when you trade, because I'm telling you, brokers candlesticks will wipe you out if you're not careful. You need to be very careful, sticking to risk management, making sure your entries are very good. So I think that's pretty much it on this, on my end. So it's quite a simple strategy. Yes, I know what else I wanted to share. So it's quite a simple strategy. What you can also do is that there's so many indicators you can use nowadays, that there's an indicator even for this W and M formation. And so what you can do is you can download this indicator, and it will highlight the sell opportunities, which is the M, and then the buy opportunities, which is the W. So with cell M formations, it will color the triangle red, right? So you know it's a sell, and then there'll be a red arrow, and then you know it's a sell opportunity. And then on the buys, it will identify the buy W's for you. It will put an arrow for you to show you where to buy. Again, green for buy opportunities on the W. So there's an indicator that does that for you. And so when you wake up or when you're free, you're just looking for it to show you the opportunities, and then you just place the trades. So this is a better opportunity for people who are busy, right? Who can dedicate maybe, say, a few minutes in the morning, a few minutes in the afternoon, a few minutes in the evening, to just check through their charts to see if there are any signals which are provided by the indicator. So the indicator will provide a signal for you. You can also set alerts, so it will alert you and send you an alert on your phone to tell you, hey, there's an opportunity on the euro US dollar to sell. And then if you put the indicator as an expert advisor, an expert advisor is different to an indicator, in that the expert advisor will not only signal to you and send you a message and say, hey, there's a sell opportunity on the euro US dollar. It will place the trade for you. It will place the trade for you. All you have to do is basically say auto trading, and it will place the trade for you. You can set the stop loss parameters, which means you can say whenever it enters, it should set a stop loss of 35 to 40 pips. And when it will enter, it will stick to your stop loss, it will stick to your risk management. It will risk 1%. If you tell it to stick to 1%, it will risk 1%. It will put in the stop loss pips you've set in your settings. It will do all the automatic trading for you. So it will trade, say this happened in the evening, it will place the trade for you, take profit, and then if this happened in the morning, it will automatically place the trade, take profit, do the same thing again in the afternoon, and basically it will trade for you. So that's a great opportunity for people who are saying, I want something which is simple and which works, and I also am struggling maybe to identify the W's and the M's, and I want automatic trading. So that's something to consider.